Okay, if you are interested in Palantir, in any sense of the imagination, whether you're someone who's already invested, whether you're someone who's down a lot of money, whether you're someone who wants to be an investor, whether you're someone who's just curious about the company and really trying to understand like how do we value this company? How do we think about this company? This is the most comprehensive interview you will ever see. I'm calling it right now. There'll probably be more in the future, but as of now, January 2022, this is one of the best interviews that you will ever see on Palantir, and specifically Palantir's valuation. The reason for this is because I had an investment banker come on. His name is Sebastian. He works for a company in Los Angeles, and this guy knows what he's talking about when it comes to numbers. I mean, this guy knows and understands the bear case, the base case, the bull case, the super bull case when evaluating the company. It's literally what he does for a living. You need to watch the entire thing full through. You can skip the beginning because we just talk about Sebastian's like introduction and to investment banking. But after you get through the beginning, you need to watch the entire thing, because what Sebastian does is he takes his model and he explicitly breaks down every term and definition in the model to help you make sense of the model. And then he does comparisons that you have to watch sort of chronologically to be able to make sense of how we get to the price. Don't just skip to the end to see his case for the price. Like it's not going to be rewarding from an educational perspective if you just skip to when he says what the price should be now versus what the price should be in 2030. Like, it is really, really important. Either it's playing in the background or you're looking at it to just listen the entire way to actually understand what this company can do. Sebastian is someone who did a phenomenal job on this podcast by actually breaking down what these terms mean. So when we're talking about price to earnings, I know a lot of people think they know what price to earnings is. Most people don't. Most people don't get what price to sales is. Most people don't know what earnings per share is. Most people don't know what adjusted operating margin is. Like, I'm someone who can fully admit I don't know all these terms, which is why I explicitly asked him to explain what is a multiple. Like, how do you define, like when Amazon's trading at a 55 forward forward earnings multiple, like what does that mean? How are you evaluating Amazon 55 times more than it's worth next year's earnings? Like he really breaks down these terms, and then he sets it up to ultimately come back to Palantir as he's breaking down these terms, and then walks us down to what the price should be right now. Hint, hint, it's undervalued. What the price should be in 2030, and what the bear, bull, and base cases are from management's guidelines, and also from just like, if we assume Palantir can really get to some good levels or even some decent levels, how they can get to a stock price that is going to be a substantial return or not a substantial return based upon how we plug and play with the numbers. It is something you really need to watch and understand, because it will give you one of the most comprehensive understandings of Palantir from a numerical perspective. Now, we talk about subjective stuff, like we talk about dilution, we talk about this, we talk about that, we talked about the long-term vision, and Sebastian does a really good job explaining his perspective on those things, and that influences the discussion. But the numbers at the end of the day are so critically important, because I think this is one of the only things I've ever done or I've ever seen in terms of a piece of content that actually breaks down the numbers. Now, final thing I'll say before I get into it, I thought Sebastian was like a bear when it got, because he didn't send me his evaluation before, so I really didn't know how he thought about it. We just connected on Twitter. I liked his vibe, but he seemed kind of bearish with his tweets just in terms of valuations. He's actually very bullish on Palantir. The only stocks he owns in his portfolio are Tesla and Palantir, and Tesla's about 80% and Palantir is about 20%. So this is coming from someone who doesn't have something or an agenda against Palantir. This is someone who has literally put his money where his mouth is in terms of what he thinks of for Palantir. But it is someone who is doing a numerical evaluation, and there's a reason why he's only 20% Palantir, 80% Tesla. So please watch the whole thing. Leave your comments. Would love to know what you guys think. This was an amazing, amazing podcast. And please follow Sebastian on Twitter. I mean, after you watch this, he deserves it for what he did on this podcast, really breaking down all the terms and making it actually understandable. I think it was one of the best things we could have ever done as a Palantir community to understand more about the company at this current stage. So yeah, hope you guys enjoy, and here it is. What's up, everybody? We have a special podcast episode today. I'm here with Sebastian, otherwise known as a suit in the investment banking world. It is going to be really interesting to get to know a little bit about him today. We're going to do a couple things in this podcast. Number one, we're going to get to know a little bit about the life of an investment banker, because I think that's very interesting, and it'll frame some of his perspectives that he has on stocks and how he thinks about the world. Two, we're going to ask him a little bit about Palantir and sort of what he thinks about the company, because he's had a lot of thoughts. I met him through some YouTube comments and some Twitter conversations we've had. And then three, the biggest part, he's going to introduce a real discounted cash flow model. Sebastian does this every day for a living. He goes super technical to it. So this is going to be a very technical podcast with him explaining this stuff, breaking it down. And I have not seen his valuation yet for Palantir. I don't know what he thinks the company should be worth. I do think he thinks the company's overvalued. So we're going to get into some conversations and duke it out. So Sebastian, please introduce yourself. Who are you and what is it like being an investment banker?
Yeah. Thanks so much for having me on. It's a pleasure. I love watching your videos. So for me, I guess like my role in investment banking, just I guess taking a step back here. So the bank's role specifically is simply to connect buyers and sellers, like in the simplest way possible. That's what it does. So whether that's raising debt or raising capital for a firm that wants to be able to use the capital for whatever it needs, or if one firm wants to acquire another firm through an M&A transaction, it's always a buyer and a seller. Whether the seller is that firm that's issuing debt and the buyer is bond or loan investors, whether it's a company selling itself to another company. And so my role specifically on the banking side is, I think the whole term like investment banker is almost like a misnomer because we don't do any investing. We don't do any investing. So there's like the public side and there's the private side. So I'm on the private side. So with that comes a lot of restrictions. But on the private side, we're not privy to. I shouldn't say we're not privy to. On the private side, there's like a wall, almost like an invisible wall between us and like equity analysts. So like when you hear like price targets being issued, those are like from the equity analysts who are on the other side of this wall. We can't talk to them. To them. So they're exposed to like public information, works like only available to the public. We are given private information. And so as a result of that, to avoid any insider trading rules, we are not allowed to buy individual securities. We can only buy ETFs or index funds, and even some sector-specific ETFs we're restricted to buying. We can't buy those. And if we want to sell a stock in individual security, then we have to sell the entire position. So when I accumulated my Palantir position, I did so before I entered into my role. And so anything I say about Palantir is just as a disclosure. It doesn't reflect any of the views from my company. This is just my own personal views. And these are the views I have as of when I bought the company before I started working for the investment bank.
So let's get into Palantir. First off, when did you hear about the company? And you said you started a position before you had this role. What kind of excited you about the company? And what do you think like the company does in general? Like, how do you think of the company?
I saw Alex Karp. I just knew something about this guy. It was crazy. I just looked at him one day and he was on CNBC. I'm like, who is this guy? And then I all of a sudden went down. I don't remember exactly what was like the first video I watched. I think it was Jackson. In his YouTube. Yep. Yeah, Palantir Vision in his channel. I watched one of his videos because I was just interested in the company. Really didn't have a good idea what they did. Like very little idea. And then all of a sudden I stumbled upon Sachin, you later, Tom Nash, Max Maher, I believe that's his name. So a bunch of different people. Like it just kept getting literally the YouTube algorithm. That's basically it. The YouTube algorithm kept feeding me over and over and over again. Then I translated that over to Twitter. And that's kind of how I got to really know about the company. And I didn't really have a Twitter up until I don't know even when I joined. I think it's been a year. But it's been about a year. And it's been like just a monumental shift. And I feel like the knowledge you can gain. And that's very true with Palantir. Because I feel like definitely without Twitter and without YouTube, the knowledge I have of the company would be much more limited to what I feel like I have now.
Twitter is the most powerful network in the world that can't monetize. Like
100%. 100%.
So I thought you were going to give a really technical argument. You said Alex Karp. I love it. That's so good. So besides Karp, like what do you see as like just the value proposition of an investment in Palantir?
I guess just looking at like the secular trend of where the entire world is going, like just looking at the macro. So I guess his last interview really, really put it well, where he said, if you look at the world and where it's going, you have to take a step back and say, is this world going to be way more data driven than it was in the past decade? Yeah. And if so, then how are you going to be able to analyze that data in a way to make decisions that are data driven and could be value additive? So there's got to be, I was thinking like, there's got to be a company out there that really had a way to aggregate all this data. And it became clear to me that's exactly like what Palantir does.
Right.
And so that's what really got me interested in the company, because I felt like there wasn't a company that went all across the layers of within an individual company to provide them a solution that would be so integrated that could really be value additive. Because if you have one solution at one layer of a company, maybe not necessarily super value additive, where it can be transformative to the business that uses them. Right. But when Karp explained it, and then obviously later on finding out through Twitter and YouTube that this is almost exactly what they do, having an ability to analyze your data in a way that can give you a correct decision, I think is incredibly important.
So you saw sort of like the core value proposition there as well. Okay. Yeah. Makes sense to me. Let's get into it. Can you share your screen and show your DCF?
Let's do it. Let's do it.
Let's talk about how you value the company.
All right. So can you see my screen?
I can see it. Yep. It's all yours.
Right. So I guess taking a step back here before getting into it, I'm a bull. I'm not 100% bearish on the company. What I am bearish on is that I feel like the return opportunity for Palantir is a lot less limited, is a lot more limited than what people think it could be.
Okay.
And it's simply a function of primarily what management has said, what management has told us. And this is not like them not using like what they have sandbagged their guidance. Like we as shareholders, I think a majority of us believe that they sandbag their guidance consistently.
Yes. We think this 30% year over year thing has to be 45 or 50 for us to really get the value of it.
Exactly. But this is where I have a problem. It starts right there with exactly you just said. Karp said, and he kind of reiterated this in his last interview, but in an interview a while back, he said he sees that this company should be at least 20 times. I didn't say at least. It should be like 20 times bigger. And you and I discussed, we're pretty confident that's on a revenue basis. So if you take the 1 billion in revenue they had in 2020 and say 20 times that's 20 billion in revenue. I'm assuming this is 10 years out, so 2030. So call it 20 billion in revenue in 2030. Or he could have been talking about 2021 revenue of like 1.5 billion. They've estimated for 1.527 billion. 20 times that is 30 billion. So I like to say, let's cut the difference. 20 billion 2030 or 30 billion 2030. Let's just go right down the middle and call it 25 billion.
Right.
So that's my base case assumption. And I say that because why would I believe a bull case where we can grow at 40% when that's not Karp's own vision? And then he paired it back in his last interview. And then he said before, he was like, there's no reason this company shouldn't be 20 times larger. Then he said should be 10 to 20 times larger. I know these numbers can be I know these multiples can be arbitrary. Like he's just gonna be talking and giving a range. He's not really thinking about it in terms of an investor perspective, just maybe more of like an entire company.
But there's a reason he didn't say 50 and he said 20. So there's some merit there, right?
Yeah, exactly. There's definitely some
like
merit.
If he said 50, we would be like, oh, he's talking in hyperbole, but that's not sort of what's going on.
Exactly. So but what I'm trying to get at is why believe a growth story that's more than what he even thinks the company can get to. So if you take 25 billion in 2030 and they get 1.5 billion in 2021, that's a 36% growth rate. That's my bull case. The whole bull case, like I can go into this formula here. The whole bull case is saying take 25 billion in 2030 and then divide that by the 2021 expected revenue. And there's 9 years between the period of 2021 to 2030. You take 2030 minus 2021, that's 9-year difference.
Right.
And then you minus 1. So that gets you to a compounded annual growth rate of revenue of 36%. That's the bull case. So why believe, I always question, why believe anything more than that if Karp himself sees that's where the company's potential can get to?
And that's assuming 20 times revenue 2030.
20 times revenue of 2021 or 2020.
Of 2021, right. So the only way that we are incorrect, and I agree with what you're saying, right? You're saying the CEO is saying 20 times. I'm taking him at his most bull case argument. And your argument is yours, like, there's no way he's sandbagging that. Management is sandbagging guidelines, but Karp saying 20 times is not sandbagging that.
Exactly.
So we would have to believe that it might be 30 times or 40 times for like the ultra bull case, which is going against what Karp is saying in order.
Exactly. That's what I'm saying. If he's the one that we rely on, why believe something he himself doesn't believe? Now, it can happen many times where management underestimates how great their product is.
Right.
That happens. Zach Kirkhorn, like CFO of Tesla, like he said on the call, like they were surprised by the amount of demand they had for their cars. They were surprised by the consumer sentiment shift towards electric vehicles and how fast that was happening. That can happen where management believes something, but it ends up being way bigger than they actually think it's going to be. That can happen. That's why there's a Super Bowl case. The Super Bowl case analyzes that.
Right.
But in the general case of just saying what Cart believes, that's my bull case. Because
Got it.
as a shareholder, I can't feel convinced enough to invest on something that he himself doesn't see.
One thing, so before we get into the DCF, one thing I want to challenge you on a bit is sort of like Elon has said many times that the stock price is too high, right? And he said that because he believed it's egregiously high. But the shareholders of Tesla and the market ultimately valued it as that is the one monopoly of electric autonomous vehicles that no one else is going to compete. GM, Ford, they're not messing with it at the end of the day. And then you take in the energy. There's so many factors that led to the obviously cult following, but also the general market dynamics that I don't think was just hype, in which investors were like, I am willing to pay $800-900 a share for this thing because it makes sense given the growth story. Elon himself didn't really believe that, given his literal tweets of saying the stock price is too high. So is there a world in which it's not that crazy if, the comparison is Palantir is the Tesla of data, where the growth is that exponential, they are attacking that many verticals, where it's not 20 times, it is 30, 40 times in somewhere? Do you think that is possible, or do you just want to stay away from that kind of comparison?
I stay away from it because that's a call option that you have that you get for free. That happens, great. It's icing on the cake. But as a shareholder, I like to believe in a base case that I can still make money, but at the same time, I got to taper my expectations a little bit to see what's my return going to be in 10 years.
Got it. Okay. Makes sense to me. Let's get into it.
So this is it's pretty dynamic where you can see you go one, it'll switch to the bear case. So you look at 2030 revenue, it changes.
You investment bankers, Excel, man. Excel inside out.
It's really crazy. 2, you can look at the bull case. And then, 2, you can look at the base case, and 3, you can look at the bull case. So let's just start with the base case here. We can walk through some of these assumptions.
Okay.
So the revenue growth, 30%. That's basically just management guidance. Now they've guided to 2025. Now we can say, are they at the beginning of their S curve? We can debate all of that.
Mm-hmm.
Now this is not entirely very dynamic in the sense that they're not going to grow 30% 1 year over. 2022 is not going to exhibit 30% growth over 2021. It's going to be 40 or 35. I don't really know exactly what the number is, but overall, it's going to work itself out to be a 30% growth rate annually from 2030.
Right.
Now, whether that's in 2029, that's 20%. Whether in 2029, that's 20% growth year over year when you get to 2030, or in 2022, it's 40%. They average out to 30%. All I did is I took straight 2021 revenue estimated, what they guided for 1.527, and then just applied 30% each year off of that. Yeah. And that 30% comes from management guidance. And the adjusted operating margin. This is where I love Tom Nash and I love Jackson, but their valuation does not take this into account. And I think and margin is a huge driver.
Can you explain what adjusted operating margin is?
Yeah, so it's basically just their operating income. So the way you get there, the way you walk from revenue to operating income is you take their revenue, you less the cost of revenue, and you get to gross profit.
So it's just profit at the end of the day.
Oh yeah, basically profit before taxes and interest.
Gotcha.
Because Palantir has basically de minimis amount of debt, we don't have to really worry about interest. Taxes, we're going to call 20% when they're profitable. Now, you had mentioned in one of your videos that they can carry forward a lot of losses. Right. This doesn't really take into account all of that. Just a straight 21% corporate tax rate, which is obviously we know it's going to be a little bit higher than that, but lower than that, the actual tax rate that they're going to pay.
Right.
But for the operating margin, this takes into account, you take revenue minus cost of revenue gets you to gross profit. Then you back out R&D and sales and marketing. You don't take into account and general administrative. You don't take into account stock-based comp here because it's adjusted. Right. So it's adjusted for stock-based comp. Now you can take into account stock-based comp if you want to get to GAAP true operating margin, but many tech companies have a very, very similar model. And on the point about stock-based comp, I don't have a problem with it.
That was one of the questions people asked me for you. How do you feel about that as an investment banker?
If it helps grow the top line at a rate that exceeds what we get diluted as shareholders.
So the share dilution is not the craziest red flag in the world to you?
But here's the thing. If you look here, this is their, I'll zoom in. This is from their S1. which is a public filing before they went and did their DPO.
Right.
Their fully diluted shares on their S1 is 2.2 billion. Today, they're at 2.2 billion. So there's not a problem for me, really. And they're gonna have dilution, share dilution. It's gonna happen as they bring in more customers, more members into the organization when they have more employees, especially for the sales team. So they're gonna have some dilution. Now, like each case takes into account different levels of dilution, like 4% in the bear case, 3% in the base case. Obviously, the less percent dilution per year, the better. The less you're getting diluted as a shareholder. Now, the one issue I do take, like one challenge I had for like the company is they had a shelf offering in which they issued shares, I believe last quarter. Yeah, it was last quarter. And they didn't explain it. They didn't say what the proceeds were going to be used for. Now, we can almost figure out that it's going to be used to buy into the pipes and more SPACs, which again, don't really have a problem with as long as it builds the top line. But tell us that's what you're doing.
Right.
Why hide that from us? And why dilute shareholders if, I mean, I believe in management's vision that they'll be able to turn this into something that's bigger than what we think as shareholders, or that maybe some of us have gripes with, but communicate that to us. Say, why are you diluting us through a shelf offering? And a shelf offering is good for 3 years. So what that means is they've issued like they've registered a number of shares to be issued with SEC. Do they need to register? Do they need to actually sell those shares? No, they just have them on the shelf that they can pull from at any time.
Right.
But they have that option, which scares me a little bit because that means they could easily dilute us without us even like having a whiff of it coming at any time.
They would sell it. They would do an at the market offering for that, right?
Sure. Yeah, you can do that. Yeah. So that part a little concerns me that they have this outstanding shelf offer. I mean, shelf offerings are very, very common though.
Right.
But the fact that they didn't say what it was for, that's what I have a gripe with.
Do companies usually say what it's for in your experience?
They'll usually file like an 8K, which is like a material event, and they'll usually disclose like what they're going to be using it for.
Gotcha.
So it's a little strange why they didn't say anything. So then you get the operating margin here, 30%. Now, this is where it becomes a huge challenge. We're going back to the margin point. If you look at the investor presentation that they had at their investor day when they were going public, they guided for long-term 35% adjusted operating margin. This is a CFO.
Okay.
This is what they guide for. This could be a sandbag. But every quarter since Q1 2021, going back here, every quarter since Q1 2021, their margin, adjusted operating margin, has decreased. Why is that? Well, it's because they need to hire a sales team. They're increasing their sales unit, but at the same time, what's happening? They're going down market. So they're going into the smaller companies, but they have the same increase. They're increasing their sales staff. That doesn't say that they don't work with very large companies. Like you did a video where you said like they work with CVS, Wendy's, GM, like Hyundai now, obviously, is another example. Like, it doesn't say that. It doesn't mean that they don't work with like these big companies, but they're also going down market, but at the same time increasing their sales team, so their margin is going to get hit.
Right. They're paying more for sales and marketing, but they're getting less revenue per client because they're going more downstream to different clients.
Exactly. So what, like, I'm trying, like, in the base case, I'm saying is when they came out with their investor presentation, like when they released this, like in 2020, late 2020, I don't think they thought that the sales bottleneck would be as big of an issue as it clearly is now. Karp admitted at this military conference. He reiterated during his last interview, there is a sales bottleneck. They are a very product-focused team that needs to make a shift towards a sales focus. And part of me thinks that maybe they were sandbagging the 35% long-term, greater than 35% long-term guidance. But the other part of me is saying, well, did they foresee this this sales bottleneck? Did they foresee an issue where they're going to have to spend more on sales and marketing to achieve the same level of revenue growth that they've guided for, 30%? And I think they're going to have to. And you're clearly seeing it now. You're seeing the margin come down.
I mean that makes sense. My thing is, like, I think there's just a network effect. Like, at the point where like CVS is using Palantir, Walgreens is going to want to, be interested in, like, I think the product will sell itself and be that golden product that does what they want it to do. But in the beginning, first couple of years, they're going to have to operate at lower margins to get the sales and marketing up.
Agreed. So there is a case that can be made that eventually the margin will start going back the other way, and it will start, the adjusted operating margin will start to improve and trend towards that 35%. I'd like to be proven wrong here.
Right.
I really like to be proven wrong here.
Okay.
But I don't know. Like that's a big if for me. And as an investor, I want to conservatively say 30%. In other models, I've seen like 40%, 45%, 50%. And that can be common for software businesses, but that's not what management's guided for. And right. I know they could be sandbagging, but they also at the same time, I don't think foresaw this big sales bottleneck they're going to have to address. That's right.
So as an investor, you either have to come down on the question here as in, do you believe enough in management and the product that it will one day be ramped up to the point where they just don't have to spend as much as they're doing on sales and marketing and they'll figure out the sales and marketing problem? Or do you believe they'll figure it out, but it's going to cost some money to figure it out in order for it to actually work?
Exactly. Share dilution point we covered. So I just assume like 3%. It's pretty standard. I mean, it's a little bit higher because of the fact that they have such a high stock-based comp. But still, it's not like crazy. And then the multiple, this is a question I debate a lot of people on. And
can you define for me what is a multiple and why do companies get multiples?
Yeah, so that's a great question. So a lot of times in DCFs, like true DCFs, like this time I didn't forecast out to like free cash flow. In a DCF, you'll want to forecast out to free cash flow. So you look at things like EBITDA, which is like their operating income, but add back depreciation and amortization. And because this is a software business, it's going to have a lot more amortization. And they'll look at like an EV to EBITDA multiple, so the enterprise value to EBITDA. For me, I like to look at, specifically for Palantir's case, I like to look at like a PE multiple because I can get to net income. It's pretty simple. You just take the revenue that they're expected to get, that's the 30% growth. You can get the margin, which is the 30% we just talked about. That's operating margin, which you can get to operating income. And the only line items left are interest, which basically Palantir has none of, right. the minimus amount, and then taxes of 21%. And boom, there you go, you get net income. And then you can forecast out their share count, which is what we've done here, by assuming what their share count is today, and then annually increasing that by 3% in the base case. And then you get to 2.9 shares outstanding in 2030. And then you get to like adjusted earnings per share. And then the multiple is on the price to earnings multiples on the earnings per share. So it takes this assumed, it says that in 2030, we're going to get to $1.34 in adjusted earnings per share.
And earnings per share means for every share that they have, they will make $1.34. That's the definition, correct?
Exactly. So the multiple then says, let's take this earnings per share and multiply it to get to the share price.
Why do companies do that? Why does the market multiply something by the earnings per share to get to a share price?
So the best way to think about it is like, here, we can go this might be the good time to look at this. Like, so this is like big tech. So this is big tech multiples. And Peter Lynch, I love Peter Lynch, one of the best investors.
Legend.
Legend. He had really come up with this great principle called PEG, this price to earnings growth. So a multiple reflects the price that the price an investor is willing to pay for growth.
Right.
The lower growing you are, the lower multiple you're going to get. The higher growing you are, the higher multiple you're going to get. And he had defined that the best way to think about high growth businesses, not necessarily tech at his time, but tech today, those businesses are best bought at a PEG, price to earnings growth. So you basically say, what are you growing at? Maybe there's different ways to look at PEG. You can say like 1 year out growth, 2 years out, 3 years out, 5 years out. What are you growing at? And then subsequently, what is the multiple you're paying? So if a PEG is 1, that's saying, like, let's say a company is growing at 50% each year.
Right.
Or like in Tesla's case, like for example, I think like Tesla, for example, it can grow its adjusted earnings per share by 85% next year.
Right.
And its forward multiple is below that. So it's like 80 times. I don't remember the exact numbers. But if your multiple you're paying is below the growth rate in your earnings, he said, Lynch, that's a bargain. You're paying, and like if you're paying 1 for 1, so like if you're going 50% and your multiple is 50 times, your price to earnings multiple is 50 times. So if you're growing your earnings by 50%, then your multiple should be 50 times to be fair value.
Right.
That was in a much higher interest rate environment, though, much higher in Lynch's days. Now you're kind of seeing big tech trade relatively fairly at about, like right here, 1.7 times price to earnings growth. peg.
Meaning I am paying meaning for every dollar they grow, I'm paying 1.7 times that.
Essentially, for every dollar in earnings that they're growing, you're paying 1.7 times that. So, for example, like the long-term growth rate average from the big tech companies here is 20%
year over year.
Year over year, like future forecasted year over year growth rate. And then the multiple, the average like forward multiple, like next year's multiple, is 33.6 times, which means that the way you get this 1.7 is you take the peg is what essentially you're doing is you're taking this 33.6, and then you're dividing it by like the long-term growth rate. These are all averages here, but that's essentially what you're doing.
So does Facebook have a good peg based on this model right now?
Crazy low.
Why?
Well, I guess the simple answer is Facebook's, in my opinion, incredibly undervalued.
Yes, but from the numbers, why is it undervalued?
Because
like, why is this peg? Why is the 1.0x peg mean Facebook's undervalued? If I just looked at that.
Because Facebook, well, today, typically big tech multiples, like on average, they traded a 1.7 peg.
Got it. Okay.
So if Facebook's only at a 1 peg, essentially that's saying they almost have 70% room on the upside, just from looking at that. Just from looking at that.
So a 2x would be a 2x peg essentially means 200% growth, right?
2x peg is like saying you're going to grow next year at 20%, and we're going to pay a multiple of 40 times.
Interesting. Got it.
And there's many factors that can affect a multiple. It's not just growth rate. That's a misconception that a lot of people have. It's not just growth rate. It's a multiple of things. One, it's growth rate. Two, is your return on invested capital.
Right.
So of the debt and equity you have, how well are you investing in it? Big tech historically has just massive returns on invested capital.
Right.
I don't remember the exact figures right now, but they approach like the high 40s in some of them. Some big tech is like high 40s return on invested capital. Tesla's going to get there, in my opinion. They're going to get there. They're going to have top-notch return on invested capital. And they're going to deserve a premium multiple because of that. Like if you look at perfect examples, like Ferrari, this is where growth doesn't necessarily equate to a higher multiple. Like Ferrari isn't like a crazy fast grower, but they have a huge, like high multiple relative to the rest of the auto industry. Why is that? The auto industry trades like 10, 20 times. Why does Ferrari trade at 50 times? It's because their return on invested capital is so high. So shareholders reward that company, Ferrari in this case, for being able to have dollars that they can put back into their company to then further grow it. Versus a company like Ford or GM, their return on invested capital is below their weighted average cost of capital.
Right.
So basically it's saying like the cost of their debt and equity combined exceeds the return they can get on their debt and equity. So that's why they deserve such low multiples, on top of the fact that they're growing very slowly.
Is there a baseline peg that exists in every industry that we should be comparing to? So like this thing you're showing me right now, the average is 1.7x, and that's why you're saying Facebook is undervalued. If I look at Apple, that's 2.4x, the average of the peg. Does that mean Apple is overvalued from that metric? Like you're paying more for no reason, given you should be paying 1.7x?
If you walk through each of these, Amazon, I think, is a little overvalued, given its growth. Apple, I think, is a little overvalued, given its growth. Google, I think, is tremendously undervalued, given its growth.
Right.
Microsoft, I would say about fair. Facebook, very undervalued. NVIDIA, about fair. So to answer that question, I guess simply, yes, I would say that like Apple or Amazon are slightly overvalued.
And the average peg of each industry is what you would compare each industry giant towards that average to sort of come to this conclusion.
I wouldn't even say technically like by industry, because each company is like each company is a little bit different because they can have higher return on invested capital than another company. Like I guess going back to the example of like Tesla, like Tesla's return on invested capital is ridiculously high for the auto industry. So it's not a great comp to the rest of the auto industry.
Right.
Because of the fact that their return is a lot higher than the rest. So you have to compare it to where the return on invested capital is a lot higher. And that's typical of like big tech. So the reason why I'm comparing Palantir in this case to big tech is because I'm assuming they're going to have similar growth profile, similar margin profile as big tech. So therefore they should deserve a similar price to earnings growth.
Got it. And before we go back into Palantir, price to sales, can you explain what that means to me?
Yeah, so it's basically just taking, like, if you take market cap and you divide by revenue, that's price of sales. That's price of sales. And software companies usually trade it like, it really depends. But sometimes like you look at like enterprise value to sales, which is very, very similar metric. It's like in the 20s, typically. And now it's obviously, this is before like
The crash.
everything just started crashing. This is like in the middle of the crash. It was like in the 20s. And that's kind of historically, like not historically, but that's kind of where they've been trading like at. And those are a function also of interest rates. Like the last point I was going to make on multiples is they're a function of interest rates. Just conceptually saying like if inflation is higher, then you're going to want to, like as an investor, you're going to command a higher return.
Right.
Therefore, you want to pay a lower multiple.
Right.
Does that make sense?
Yes.
Because if the multiple is lower, then your return can likely be higher because you're paying less for growth.
Right.
And therefore, price to earnings multiples, they come down. And with inflation comes higher interest rates,
right.
which we start to see. I have my own views on inflation, which I could talk a long time about. But if the interest rate is a very low in a lower environment, it allows investors to pay more for companies.
Got it.
And so that's why when Lynch in his days, he thought like a one peg, that's fair value. The 10-year was at 5-6% in his days.
Right.
Today it's 2%.
Right.
So it's a hugely different environment. Therefore, they deserve different pegs that would equate to what true fair value is. Do I know exactly what that is? Whether it's 2 times, whether it's 1.5 times, I don't know. That's why having a comp set like big tech, which eventually in 2030, I assume Palantir is going to have a similar like profile as these big tech companies, then that's why I'm comparing them to these companies. Does that make sense?
Yep.
Yeah. So going back here, the multiple is where I get a lot of like pushback from a lot of people. And where I get at the multiple. So if you're growing faster, you deserve a higher multiple. And what I'm saying here is, okay, you're taking in the bear case, you're going to grow at 20% year over year, like compounded. So if you're going to grow at 20%, what multiple does you deserve? What this is, it's saying, let's take the 20% and let's multiply by the 1.7. That's what this is. It's the 20% multiplied by the 1.7 peg that we get here. And then you get a price to earnings multiple of 33.7 times, which is basically the average of big tech.
Because the industry average is growing at 20%. Yeah, makes sense.
Exactly. So that's why the 33.7 is what it is.
Got it.
And then in the base case, now you're growing at 50% higher growth than 20% because you go from 20% to 30% growth.
Right.
So therefore, you should deserve a higher multiple. You shouldn't stay at 33.7 times. Because as a company starts to slow, like its growth slows, like Netflix beat earnings, but its stock fell 50%. Why? The multiple came down. Why is the multiple coming down? Their growth is no longer a growth darling.
Right.
So investors are not going to pay up for that growth. Now the opposite is true. If the growth starts to accelerate, you're going to pay more in a multiple for that growth.
Right.
And so that's why, like for 30% here, I say, okay, it's growing at 30%. This is higher than what big tech is growing at. Like in the comp set, big tech was growing at 20% long term. So if this is growing at 30%, they deserve a higher peg. In this case, I'm assuming 2.5.
Right.
A 2.5 peg, which is basically what Amazon or Apple is at.
Right.
And I don't think they deserve those, but in Palantir's case, if it's growing at 30%, then I think it's very warranted to trade at 2.5 peg. And then at 36%, then you go higher peg. Like this is like 2.75, and then 40%, 3 peg. So it scales up as your growth also scales up. And that's where I get a lot of pushback. Like I see a lot of people use like much higher multiples, and I can't get there. Because if I look at like where big tech trades, and I'm assuming in 10 years that Palantir is going to have a similar profile that big tech, like in the base case, I'm assuming 30% margin profile. That's big tech. Big tech's 30% margin profile. That's what it is.
Right.
So, and why would I think that it can trade at double the multiples that big tech trades at if it has very similar margin and similar growth rates? Like it doesn't make sense.
Now, I'm assuming Tesla trades at a ridiculous multiple, and that's where you would argue is the Reddit, Wall Street, like that's the community cult stuff that allows that to happen, not the market, right?
No, I think Tesla's incredibly undervalued because its price to earnings growth, in my estimates, is less than 1. And Facebook, like I was saying, it should be 2. Like Facebook should be, it's growing faster than some of these other big tech names. Right. So therefore, it should like derive a little bit of a higher price to earnings growth. But in Tesla's case, it's growing crazy fast. And so its multiple, like in my case, like what I'm assuming is like 85% year-over-year growth. Like I think they're gonna hit like, I think it's like $7 in adjusted EPS in 2021, and then next year they're gonna hit 14 or 15. That's crazy.
So what do you know off the top of your head? What is Tesla's multiple right now?
I don't know the adjusted multiple. I can calculate right now. It's like 7. They're gonna hit this year. They're gonna hit like probably $7 in adjusted EPS. I think that's right. No. Is that right? Yeah, 7. They're gonna hit like $7 in adjusted EPS, and they trade at, what do they close at? Like 9.50 today.
9.50.
Yeah, divide by 7. Yeah, so it's like 135 on trailing earnings of this year. And then next year, I'm going to say that they're going to go from 7 to like 13, 14 in EPS. That's almost 100% growth.
Right.
So but then next year's multiple. So like, for example, like let's say you take Tesla's price today at like 9.50, right? Let's just call it 9.50. Make it easy math. So you take Tesla's price at 9.50 today, and let's say next year that they get to $13 in adjusted EPS. So you take the 9.50 and you divide by the $13 in adjusted EPS. That's a forward multiple, because that's next year's earnings. Mm-hmm. That's a forward multiple of 73 times. Mm-hmm. But if next year's earnings actually end up being $13 in adjusted EPS, and this year's earnings is 7, then what is that year-over-year earnings growth? 86%. But if the growth
is why it's undervalued.
Which is why it's undervalued. If the growth is 86% next year, but the multiple is for next year's 70 times, there's a disconnect. The price to earnings growth is less than 1, which is, in each big tech case, it's below each of these. You see what I'm saying?
Because right now you're putting a 70 times multiple as per the share price, but if you're projecting a forward PE of 135, the 135 minus 70 is where the disconnect is.
So the trailing multiple is 135. The forward multiple is 70.
That's why it's undervalued, because 70 is less than 135, right?
Yeah. So, so basically, it really comes down to like taking the growth rate and then pegging it to the multiple.
Right.
And like, that's how you can kind of get a sense of like undervalued, and then figure out like what the multiple should be. And the tax rate standard 21%. And then another way, like the discount rate in the DCF, the discount rate is based on like the weighted average cost of capital. In Palantir's case, like the weighted average cost of capital, the way you look at that is you say like, you take the cost of equity and you add the cost of debt. So the company's like, what does it cost for the company's like equity, and then what is the cost for the company's debt? Like the debt part is a lot easier to understand, because it's just the interest rate that the company will pay on the debt.
Right.
And then you take the percentage that like each company has of equity. So like in Palantir's case, it's basically 100% equity and 0% debt. So Palantir's like weighted average cost of capital, it's just basically it's like cost of equity, which the cost of equity formula is just the risk-free rate, which is the 10-year treasury, which right now is like 2%.
Yeah.
Plus the like market risk premium. So like, what is the historical return on the market? But like 8%, 10%. Usually like Wall Street will use like 8%. And then you say the risk premium is basically saying the market will return expected return of 8% per year, but then we can get like 2% yield on a 10-year. So that delta is 6%. So that's our risk premium.
Right.
So if we were to invest in stocks versus like the safest asset in the world, the 10-year treasury, then we can expect a risk premium of 6%. And then you just take the risk premium, and then you take that and multiply by the Palantir's like levered beta. So the beta is just like 1.6 for Palantir. So that means like the NASDAQ will go down like 1%. Palantir is expected to go down 1.6% in that same day.
Right.
And so that's all it is. But essentially, like the discount rate, the logic there is it's almost the exact same. And it's not even almost, it is the exact same concept as the expected rate of return for just a normal investor. So if you're discounting by the weighted average cost of capital, and the weighted average cost of capital is 12%, that's the same thing as saying whatever the present value is today, since the valuation goes out to 2030, by 2030, I expect this value today to grow each year at 12%. So it's gonna like, let's say if the value of whatever this valuation spits out is $20, and we assume a discount rate of 12%, then next year it's going to be 20 times like an additional 12% on that. You're going to grow 12% on 20.
Right.
And then next year you're going to grow like another 12%, another 12%. And then eventually it gets to your price target. It's the same thing. It's like the logic of a discount rate is it's just the expected rate of return that an investor wants to make. So,
but what is the relationship between that and this 20%, 30% growth rate? Like, why would I expect 12% if we're growing at 30%?
yeah, so it's kind of arbitrary. That's a great question. It's kind of arbitrary. So this is why, like in some DCFs, you'll just see like people just put 15%, 20%. It's because they want to buy a stock that will grow each year, expected to grow each year like 20%, compound annually at 20%.
Right.
And so like my hurdle rate as like an investor is like 20%. Like in the private equity space, a lot of investors have a hurdle rate, like a hurdle rate is like a targeted return, like a minimum threshold to invest in a company. They'll have like a minimum threshold return of like 20 to 25%. So this number, like if you change it, we can change it and like sensitize it, like to see like what that would look like, how would it change like the present value. But essentially it's kind of arbitrary. It's like whatever you want, whatever you expect to earn in return, or what you want for your return.
Gotcha.
Yeah, and the tax rate's pretty standard at 21%. And so the way we do this is we just take like the revenue, and then we multiply by like an additional 30% each year. It grows at 30%. Does the same thing all the way till 2030, get to 16 billion.
Right.
And then let's see here. Yeah, and adjusted operating income is just taking the 30% margin, and it's 30% of revenue. That's how you get the adjusted operating income.
Okay.
So
the 4 billion would be in operating income in 2030.
Yeah, basically, like 5 billion. So it's like 30% of the 16.
Yeah,
that's the adjusted operating income. And then you just take the like taxes out, since we're basically assuming no interest. You take taxes out, and then you get to your net income in 2030. So this is like my expected net income for the company per share in 2030.
Okay.
Not per share. Not per share. Sorry. Like, just generally. So it's like I'm expecting 4 billion in 2030 net income for Palantir.
Okay.
In the base case. And then what you do is then to get to an earnings per share, because ultimately you want to get to a stock price. That's the whole goal here, right? So what you want to do is you want to take like the earnings per share, which you get that by saying, okay, like take the net income, and then if today they're at 2.2 billion shares outstanding, and each year we assume that share count's gonna grow by 30%. That means by 2030 they'll have about 2.9 billion shares outstanding. That's a lot of shares. 2.9 billion shares outstanding. So all you do to get to the earnings per share is you take the net income, which is the 3.84 billion, and then you divide it by the 2.9 billion in shares outstanding, and you get to an adjusted earnings per share, because this takes out stock-based comp, of $1.34. That's my expectation in the base case for Palantir.
Okay.
And then from there, you say, okay, this goes into the multiple. Then you just say, okay, what multiple are we going to pay on this? That's what was going into like the whole growth rate idea. Like, what are they growing at? What's their margin profile at? So that's why we assume if they're going to grow in the base case at 30%, then let's say they warrant a 2.5 times price to earnings growth multiple, which would mean 30% times 2.5, which gets you to the 75 times.
Right.
And then that gets you to a 2030 share price of $100. This is why I say I'm not a bear. But when the share price was at $25, I was trying to like tell everybody, if I'm using what management thinks is going to happen, like cut back their adjusted operating margin from 35% to 30%. This is like a pretty standard base. Like it's pretty standard for a base case. I can only see at like $25 a 4x return. Good, not great. The S&P will likely return 2 times in the next. Usually they grow at like 8 to 10% per year S&P, which means that every 7 years the S&P will double. That's expected.
Right.
So why buy a company that's gonna 4x when you can buy another company that might 5, 6, 7, 8x? The opportunity cost exists.
Right.
That's why I've been like. That's where I get like, people think sometimes I'm a bear. I'm not a bear, but I like the opportunity cost when it was at 25 was not great in my opinion.
Now when it's at 13, I feel like you might be a little bit more excited.
Exactly. Like when it hit like $11 today, like now you're thinking to yourself like, this doesn't make sense.
Right.
Like this doesn't make sense. Now, like, and you can get like this applies to 6x price to sales multiple. That could be very low, like especially for a software business. Like we had talked about, like they'll usually trade at 20 times. But a lot of these
Put
software,
that number at 20. What happens?
oh, this is implied. So if you put the number at 20, you would say, okay, so it would take 20 times, and you take 20 times their 16 billion in revenue, 323 stock price in 2030.
If there is an implied 2030 price to sales of 20, you're saying software usually, oh yeah, we talked about that, usually 15 to 20. Now, why?
Yeah, it's because a lot of those software companies, like they're very like young or new. Not new. That's not the right word. They're growing really fast. Like for example, like Snowflake. I forget what it was. Like now I don't know what it is, but it's definitely over 100. I think it's over 100. Their price of sales. They're growing though. Their revenue like 100%. And that's gonna come down. So like if you look at like big tech, right? Big tech price of sales is like
gotcha.
10.5. And now, like, that's why this multiple could be a little bit lower, right? Like, for example, like Amazon trades at 3 times.
Right.
But that's also because they have like the e-commerce business. Like Azure is like the true software part of it, right?
Right.
Not Azure, sorry, AWS, like the true software part of it. But because they have e-commerce, that's why their price of sales is like much lower than some of these others. But historically, you're seeing like 10.5 times. But if you take out NVIDIA, the average is 7.7.
But like NVIDIA is getting that right now because I mean it's not a startup, but it's like it's starting to really grow. So like Palantir might maybe like 2025, 2026 get a 20 times price to sales, but eventually you're saying it'll calm down to 10.
It'll come down. I could be wrong on the price of sales, but the thing that keeps getting me like thinking that I'm not is because if I increase the price of sales, that means that the price to earnings is also going to increase. Does that make sense? Like, so let's go back to the example. You say like 20 times, right? Let's go back to 20 times and say on 20 times, what is the stock price? That's the 323 we got. But what is the implied then price to earnings? Well, then you take the 323, divide by the 134, 242 times earnings. You're not going to pay that. Like that's why I say like that doesn't make sense. I'm okay with the sales multiple being the price of sales multiple being a little bit less than big tech if my price to earnings multiple makes sense, which I think it does.
Okay.
And then you get to like an implied present value of like $36.
What does that mean?
So just it says like the concept here is saying the future value in 2030 is $100. That's what we're forecasting here.
Yes.
If the future value is $100, then the periods between now and 2030, that's 9 years, because you just basically ended 2021. So there's 9 years between there. And then you have what's it called, like your discount rate, which is 12%. So you basically take the 100, and then you each year discount that back by 12%. Does that make sense?
So like, that the implied present value, does that mean it should be $36 today, the share price? What does present value mean?
Exactly. That's what. If you want a 12% return per year until 2030, then you're willing to pay $36.
But so I'm confused about this because you're saying you at $25, you were like, it's only a 4x return. That's crap. But if you're saying it's worth $36 right now, 36 to 100 is only a 3x return.
Right. But at 25 though, like, so what I'm getting at here is saying, okay, let's take this 36, right? Each year you expect that to grow. If your discount rate is 12%.
Yes.
That means you expect 12% annual growth. That's not a lot. A lot. So that means that you do plus 12%, and then you take it to the number of periods, which is again that the nine years between 2030 and 20. You get the same amount.
But does that mean it's undervalued then? If it's even if at 25, was it undervalued?
No, it's undervalued. That's why I was a buyer, because at 25 it was still undervalued. It's just the return is not as great.
Right. Okay.
That's what I'm saying. Like at 25, the return is only 4 times. Versus like in a Tesla's case, like Palantir makes up 20% of my portfolio. Like I think 15, 20%. I don't know the exact number now that obviously the market's come down. I don't try to look at my portfolio when the market goes down.
Like this, health. Yes.
Yeah. but at 25, like I was a buyer in the low 20s. like sometimes like 16, 18, 20, 25, but like I topped out at 25 because I knew the present value today is like in the 36 area, in the mid 30s area. So, and then I knew that in like 10 years, I expected it to get to $100 a share. And so why would I go so heavy on a business where I only expect a 4x return?
Why were you even buying at 25 then though? Because like, did 4x seem attractive to you in 9 years? Like what was or did you have a hidden belief that it should be more than 4x and like you're going to take the bet?
It's because I have a conviction, like not conviction, I have a belief that there's a chance the bull case plays out, which would be massive. That's why it's only 20% of my portfolio. There's a 4x. 4x is almost, I think, I don't ever say guarantee because this is not financial advice. Nothing I say is financial advice. But I felt like 4x was like almost pretty certain to happen. But if I felt a 4x is pretty certain to happen, well, there's a small chance that if you turn on the bull case here, there's a small chance that happens, which is a 10x. There's a small chance. Now, I'm not saying that's not possible but I believed in this enough that I'm saying there's a chance this happens.
And the belief was more subjective, like Carp is daddy type of stuff, right? Like that's where you got.
No, not that. Just like this guy has such a big vision. This guy has such a big vision for the future, and he believes that this company can be a 36 compounder. The bull case is Carp's case.
Right.
This 36% is getting to, you see, 25 billion in revenue in 2030.
Right.
Which is the midpoint of what we were talking about, the 20 to 30. Because if you take 20 times 1 billion in 2020 or 20 times 1.5 billion in 2021, split the difference, call it 25 billion in 2030. That's what Carp believes.
So if you're bullish on Palantir, and if you were a couple months ago, you could 10x your investment. If you are bullish now on Palantir, it's almost like a 15, almost 20x based on the market conditions.
Yeah. Right now it's crazy. But when it was at 25, I was trying to, even like sometimes in the 20s, like, don't get me wrong, a 4 to 5x return is great. Like that's really hard to do. But like I felt like the sentiment was this is going to be a 10x at least.
Yes, no, you're 100% right. And in 9 years, 4x, the opportunity cost is, for this type of company, it's not what we expect at all.
Yeah. And that's really it. I mean, you can change the discount rate. Like if you look here, like if you change the discount rate to 15, like and you assume 30% growth, the present value dips to $28. So yeah.
Go ahead. You got it.
Like this is just saying, if your expected rate of return, if you want at least 15% per year, then the max you'd be willing to pay, if you're assuming 30% revenue growth, 30% operating margin, adjusted operating margin, the max you're willing to pay today for fair value would be $28.59.
Okay, so let's go to the Super Bowl case. Let's go to the Tesla of data case. But that would be almost at $1 trillion market cap, because 500 is like,
it is $1 trillion.
But so that Super Bowl case is
it basically assumes some sort of consumer-facing product, something that we don't know of.
I'm gonna get your thoughts on that. I think Tom Nash kind of incepted this idea into the world that we need this consumer. I agree with it to some extent.
I agree.
You agree with? Do you think there's no way an enterprise company or even a small size B2B, you think they have to go for consumers to get to $1 trillion?
No way they get to $1 trillion without some sort of consumer-facing product. Like, let's look at each of these. Consumer-facing. I would say implicitly consumer-facing.
But they don't sell they sell chips to businesses. Like when everyone says about NVIDIA, that's where I go against Tom. I'm like, he says Salesforce is like the sort of market cap pound. I'm like, but like we got NVIDIA. And on top of that, if we, now let's talk sort of like subjectively, like, right? If we believe in this sort of growth vision, where if you go on Foundry's website, there's 40 freaking verticals that they fit into. And then you talk about Carp modularizing Foundry. You talk about crypto that's exponentially growing. You're talking about blockchain, healthcare, drug discovery, and the other one, energy, that's exponentially growing. If we believe in sort of this Cathie Wood S-curve thesis, which is why I think she's buying it heavy as well, is there a world in which they don't need a consumer product? They just need to be literally everywhere in order to get that close to that trillion.
I guess so, but I don't see them getting there. Because here's the thing that I push back on. Karp had said in his latest interview, like if you look at like he was talking about, I love the question by the interviewer. He's like, you look at competitors like Snowflake or Databricks, like how would you see yourself compared to them? He's like, they have to worry about being thick enough to be valuable.
Yes.
We have to worry about being thin enough to be monetized. So slicing up Foundry, and Sachin had an article on this. Like he put it so beautifully. He was like saying that Palantir exists.
I'm gonna stop you sharing, by the way. So it's just.
Oh yeah, for sure.
Yeah. Cool. Go ahead.
Palantir exists. So like across all layers of a company, it's very integrated. Because of how integrated it is, in order to like we think of Palantir right now as the operating system for the modern enterprise. So in order for Palantir to really sell that model, then it has to sell to the C-suite. And because of how integrated it is today, it needs to sell to the C-suite because the C-suite is going to decide how integrated they want Palantir to be in their company. Because if it's going to be the true operating system for the modern enterprise, then it's going to have to come directly from the C-suite saying, okay, we want to adopt Palantir for our business. Additionally, this is why I think some of the smaller companies, that's why it's like Palantir is maybe targeting them more right now, because it's easier for these companies to adopt Palantir early on. And you see some other companies like obviously Wendy's or like CVS, like they're obviously not using Foundry across their entire business.
Right.
So it's been done, or they're doing it in a way where they're slicing up Foundry to be used at one specific layer. But then what is like Karp and I'm blanking on their COO name.
Cohen, Peter Thiel?
No, the COO. He's
Shyam.
Yeah, Shyam. Sankar. So Sankar always says on calls, our competition is not other competitors, it's our customers, because they feel like they're going to have an internal way of doing things where they don't need an external solution like us.
Right.
But this is where I say their revenue growth needs to be a little bit like tapered down, or the expectation of what the revenue growth should be tapered down, because as soon as they go into the thin enough to be monetizable phase, or they're already probably there a little bit right now, but Karp really has to get to scale that he knows they have to get there. What happens? Now you have competition. Who is your competition? Snowflake, Databricks. You're gonna have a whole other sea of players, and once that starts to happen, then your competition is no longer just your customer. Now the market is huge. The market is huge for this, so there can be many players, but it's not going to be a monopoly. And how well are they going to be able to compete against some of these other thinner solutions if that's not Palantir's core? Palantir started its core as an integrated model. Now they realize to scale, they have to become thinner. But now you have companies like Snowflake or Databricks, which are already thinner. That's their game. That's their niche. So Palantir is going to be going and playing against these guys. They could win. They could take some share. But that's where I'm saying, like, this revenue growth, 30%, that's where I keep my base case. I don't like to have any sort of other like extended case. Like I could believe maybe the bull case that Karp believes. I could believe it because I feel like he could be a visionary that could lead this company there.
But besides being a visionary, if they have a monopoly on the thickness of the value proposition of their product that the other competitors can't go against, isn't that warranting enough for some level of a bull case, 36% year-over-year growth?
Maybe, but they have to convince the companies that they need that. And I just don't see like all these major companies.
Really? Maybe. Because that's the part, and maybe it's just because I've done a lot of research on it. I'm so deep into it every day, but that's the part where I'm like, I mean, we're in some Palantir group chats. We're seeing staffing companies hire Palantir as like for the job district. Like there's a lot of stuff going down the pipeline where I'm thinking organizations are starting to recognize the value. That's the part where I don't think there's going to be an issue.
That's true. And that's where I invest, because there could be that outsized chance that we see the 36% growth Karp is talking about. And that's
Karp talks about Foundry being integral to the ontology of an organization. We don't have to go into that, but that to me is where they get the 0-1 monopoly thing, right? It's like, yeah. I don't think Snowflake's data, I don't think they do that. And okay, so let's talk about this. The government stuff, does that play any question into your evaluation of them getting to that not Super Bowl, but bull case of just like?
No, because I think the government is limited. Like the upside there is limited.
At one point, what if Palantir's like, hey, it's $1 billion this year, take it or leave it, and the government has been working with them for 6 years at that point, and like the government knows there's no one better. Like that to me is what I kind of think about. Is there any scenarios where you think, oh, the government could potentially, or you're just like commercial is everything?
No, I mean, I think the government, the government side of the business is completely overlooked. Like Wall Street focuses solely on commercial growth. Like almost not, I would say solely, like almost entirely though, on commercial growth. Like that's their focus. And when I say Wall Street, like this is coming just from like an investor perspective, not like from my actual role. But they focus on it like commercial growth so much that I feel like they get too into the weeds and overlook the government side of the business and how much that could still grow. I mean, yes, it's older. Like the government business is still older, but that doesn't necessarily mean that they can't continuously grow as more and more like parts of the government start to use them, especially in 2020, like the CDC using them for vaccines. So like I agree with your point there that the government side could be a lot bigger.
But you don't think the government gets you the bull case necessarily?
No, 100%. There's no way, in my opinion, the government gets you 36% annual growth. Just doesn't happen. I don't think it happens.
So key takeaways: Palantir has a implied present value of around $36, which means even but people buying in the 20s. I know a lot of my audience was averaging up that time. I was buying at that time. You were still buying it at an undervalued price range. However, the return on that is not the greatest outlook using this model, which I think this model is pretty fair. It's one of the most comprehensive models. I think we can kind of agree on that model to some extent because it's only a 4x bagger. Now, and that's in the base case. Now, with the market volatility, we're dropping to 11, 12, 13. Getting to 100 would be 8, 9, 10x return. So people loading up now, or at least reducing their averages to some extent with this model makes some sense. But even then, the base case is not attractive to a lot of people because 8, 9x is great over 9 years, 1x per year, but we're kind of looking for like that Tesla type of thing. So I think we would all have to come to the conclusion and agree, as just shareholders of a company that want this thing to go to the moon, that the bull case has to happen. And now we're digging for how does the bull case happen in order to justify paying even $25 today, because that 25 could be 250, which means if you're buying at 11, 12, it's an absolute steal.
Yeah, exactly. Basically, if you buy it today and the bull case actually like pans out, it's 20 times. That's 20 times, which is huge. That's over 10 years, massive. But how do you get there? You get there if revenue growth is 36% per year. And you get there if adjusted operating margin is what management says it's going to be of 35%, which both could happen. Both could happen. It's very possible. But I have pushback, particularly on the margin front. Maybe I have pushback on the revenue front too, but I would say more so on the margin front because in order to get this like 36% growth, I'm going to say they're going to have to spend way more on sales and marketing.
Right.
Especially like you always hear like they're a very enclosed company. They're not. That's why I struggle with the network effects per company. Like each company is going to be using Foundry in a way. They might know like their competitors are using it, but I don't know. I don't know. Like I'm murky around there. Like I don't have certainty one way or the other that it's going to create a network effect. And
sales and marketing is an issue. I mean, they're running LinkedIn ads for God's sake. Like sales and marketing, they're trying to figure out how to communicate this. And the beautiful thing about Elon that's different than Karp is Elon is not afraid to tweet and like get things rolling. Now, obviously, it's a consumer product, but nonetheless, Karp, he cares about. Karp would never call what's her name, Warren, Karen. Like he sells his shit to the government. Like you can't do that, right? Like so, there's some ways in which Karp is not going to go there.
Revenue be gone overnight.
Right. But sales and marketing isn't absolutely understood. So my last thing for you, Sebastian, first of all, thank you for this. Was phenomenal. You did an amazing job. I think I'm going to make sure people watch this the best that I can, because for any Palantir investor, like this was one of the most comprehensive ways to understand their valuation and to understand the limitations to their valuation in comparison with all their big tech competitors, which eventually want to be big tech. It was phenomenal job. Outside of Palantir, if someone accepted your base case and was like, screw it, I don't want a 4x return, are there any other companies you're thinking about that are just like kind of that's going to be the one you want to stick with for the next 10 years? Is it Tesla, or is there anything else you're kind of thinking?
It's really Tesla. I think there's a lot of upside there just from the auto business, which I think could be massive, especially with the margins they're able to generate. When I say auto, I say like the car itself plus like full self-driving, not Robo taxi, but just like the software itself. Energy is a call option. But yeah, that's really like mainly my portfolios, Tesla and Palantir, but majorly weighted towards Tesla because I see that path a lot clearer, and the valuation leads me to believe like in a base case, you're looking at much higher return than in the base case that I would have for Palantir, with the exception of the caveat being that Palantir's like real bull case, if it were to pan out, is higher than what I would expect for a Tesla case.
Do you
But
see
I believe, yeah,
do you see the robo taxi being a thing? Because I'm kind of bearish on that. I don't
no,
see it
absolutely
being a
not.
thing, but like
Absolutely.
people really so like you still think Tesla's amazing even without the robo taxi thing.
I think the robot's going to be a thing,
The
but
robot.
that's a 2030 that's a 2030 story. I don't think robotaxi is going to be a thing. I think full self driving itself, like just consumers using it, I think that's going to be definitely a thing.
Right.
Now, I push back on the robotaxi because I think it's just going to be too much regulation in the way from the form of government. Yeah, there's NHTSA that's going to be able to rule whether or not it's going to be allowed on the streets for robotaxis themselves. There's DMVs, etc. But I just feel like the public perception around it, especially given Tesla's image in the public's, I guess like the consumer loves it, but like the government, I'm saying in the public's eye, it's good. I don't know. I mean, I never consider evaluation. Like I never make an investment in Tesla based on the fact that I believe robotaxi is going to happen.
Right.
I model it in because I have the numbers to do so based on like management presentation. Like Elon gave at Autonomy Day, he gave like figures that like very similar to the Palantir's Investor Day, where you can plug into a model and then make sense of it. So like I have a model with a robotaxi, but that's like a Super Bowl case. That's the Super Bowl case. So, but like I don't obviously I only invest on the base case. That's what I invest on. Like the bear case, I try to like throw like the worst assumptions in there, but I really invest like based on the base case for any company I invest in. And like so, like, but I obviously look at the bull case too. But
last question I have for you, coming from an investor banker's perspective, give me your raw thoughts on Cathie Wood, how she thinks of disruptive innovation and how she chooses to really consolidate to these high conviction names like Roku, Zoom. Like, do you think she's kind of crazy? Do you think she can get this 40% annualized compounded rate of return, or is that just insane? What is your take on that? Because you're a suit. At the end of the day, you're a suit, and I love you, but you're a suit. And I'm like, Cathie is her shit is against your shit, right? Like is there this class of sieves in the IB world when you guys talk about her? Like, how does that work?
I can't make sense of it. I can't get to wherever she thinks. Like I think she said like 40% annual growth somehow in her fund
for the next 5 years, based upon this deep value territory thing that she's coming up with. And like I'm understanding inflation, I'm understanding macro. Now I listened to her talk for 40 minutes straight. I get it, but like I want to know from a numbers guy's perspective, do you even think that's like do you think that's appropriate to put out there and say that? Because she's been in the business for 40 years. Like you would think she wouldn't say something so egregious to the point where, you know, people think she's lying.
She obviously believes what she's saying so deeply. Like you can just see it. You can feel it. But I really struggle to figure out like how she gets like just in Palantir's case, we just walked through it like 40%, like that doesn't make sense. I mean, it could happen, but for each company to do that, for each company that she's investing in to have that kind of return profile, I mean,
well, she must be betting that the high convictions, TDoc, Roku, Zoom, they're gonna have it and the DraftKings don't get it, but like that out averages the fund. But even then, the fund would have to be 40% year over year. And it's at 60 right now, or 69 or whatever.
I have no idea how that's supposed to happen. You know what's funny? I think her views on the economy, like the macro views, are dead on.
Yes.
Like she's almost dead on like almost everything she says. I especially like recently, like her recent episode, like in the know with Cathie Wood, like I totally agree with her line of thinking. But what's funny is her macro view, I really don't feel like it translates like to her micro view. I mean, she invests based on what she sees, but I don't know. She believes in like this convergence of all this technology is going to create like this huge deflationary, you can even say problem. But I think for the deflationary story to pan out, that's going to take years before we actually see like a true effect. I mean, we start to see it now. Like there's really like 4 secular trends that like drive lower prices in the long term, which like that's like the aging demographics, pricing transparency, global sourcing, more like automation. So like those secular trends that are obviously going to be deflationary, but to have like the convergence of all these technologies that she talks about that are truly as deflationary as she says they're going to be, I feel like that's going to be like years, if not decades, before we actually see that truly panning out. And if she's basing her investments off of that, I don't know.
But if you're a Tesla bull and this convergence rights law theory, she was the only one who really got that right in 2016. Like, does that give you some confidence that if she got it right on Tesla, she knows something the rest of the world doesn't for the others? Or
no,
no?
I think it could just be like a one-off.
I love that if you got rid of Tesla, the fund would be like $30 today.
Yeah, I love Cathie Wood, and she's obviously right on Tesla. But I think that was a one-off. You know, like these musicians that, like, you know, they have like these one-hit wonders. I'm not saying she's a one-hit wonder, because I think she's obviously going to have some decent returns. But I struggle. I really do. I really struggle to see, like, how does she, like, I think to myself, like, how is this possible? Like, she really believes it. And she believes it too. Like, she really believes it. I read her stuff and I'm thinking to myself, like, the world that she envisions, I feel like you would absolutely love to live in that world. Everybody would love to live in that world. But that world, I feel like, is at least 2-3 decades away before that even starts to pan out. I think she's going to be right, but her timing is going to be way off, way off. You know how she always compares to, like, the tech bubble and how they were too early? I feel like that's exactly what's happening to her. She's too early. Tesla, she wasn't early. She was early in the right way, but she's too early to the point where these technologies are not converging yet, and they're not in, like, they're, I guess you could say, like, some of them are prime time. They're prime time, but like the technology she's talking about, like, I forget her five convergences. I'm forgetting, like, AI, blockchain technology,
genomics.
Yeah, like especially genomics, like the Robo taxi. I can't get there. I can't get there.
All right, I got it. Man, thank you. I can't thank you more than enough to take in the time to do this. Spend like an hour and a half with me. I think the audience is definitely going to show you. Man, if you guys got any value out of this, I'm going to put Sebastian's Twitter and YouTube in the description. Prioritize the Twitter more over the YouTube because he's not posting that many videos, but he's definitely tweeting a lot. And yeah, give him a follow because this is someone you want to get your information from, because he's not perma bull, perma bear. He's just like numbers and tries to give a decent, reasonable analysis there. So yeah, man.
Thanks, man. It's been fun. It's been really fun. And just, yeah, this doesn't reflect any of the views from my own company. This is just me talking.
Disclaimer alert.
As a shareholder, as an interested person in Palantir.
He needs to keep his job, ladies and gentlemen. No one sue him. No one say anything about that. All right. Thank you, Sebastian. I appreciate it so much. I'll talk to you later.
All right. See you, man.
Bye-bye.